Alright, welcome everyone. If you've ever stared at a financial chart, you know it can honestly look like a completely chaotic mess of numbers and jagged lines just flashing red and green. But today we're going to decode that chaos. I want you to think of the market not as some random number generator, but as a visual, ongoing tug-of-war between buyers and sellers. By the end of this explainer, you're going to be able to read the exact historical battle records of any asset. You'll clearly see who's winning, who's losing, and most importantly, when that momentum is about to shift. Okay, let's dive into this. Here's our roadmap for our journey today. We're going from the absolute basics to real-world applications. 1. Chart language. 2. Basic patterns. 3. Intermediate patterns. 4. Advanced patterns. And finally 5. Stop loss and take profit rules. Starting off with section 1, chart language. So before we can spot those overarching patterns, we really need to understand the building blocks, right? The candles themselves. The chart is just a historical record of price over a specific time period, maybe a day, maybe an hour. Look at our two main warriors here, the green candle and the red candle. A green candle simply means the closing price was higher than the opening price. Buyers won that round. A red candle, the closing price was lower than the opening price, meaning the sellers won. And that thick, colored middle section, we call that the body, and it's formed entirely by the gap between where the price opened and where it closed. Now, what's really interesting about this slide is those thin little lines poking out of the top and bottom of the bodies. We call these wicks or shadows. They show us the absolute highest and lowest prices hit during that specific time frame. Wicks are absolutely crucial because they represent market struggle. They represent rejection. They tell us exactly where the opposing side fought back hard in our tug of war. Literally, if you see a massive wick, it means intense buying or selling happened right at those specific levels. And you know, the size of the body tells us a pretty crucial story too. It reveals the strength and conviction of the winning side. Look at the big body candle on the left. Buyers drove the price up with practically no opposition, closing near the absolute high. One side is in strong, clear control. But look at the small body candle on the right. Both buyers and sellers pushed the price wildly up and down, creating those long wicks we just talked about. But eventually, the price closed really close to where it opened. That shows a fierce, tough contest with an insignificant difference in power. Moving right along to section 2, basic patterns. Alright, now that we've got the basic language down, let's look at our first specific battle formations, starting with patterns made of just a single candle. First up is the bullish pin bar. Visually, you're looking for a small green body, a massive lower wick, and almost no upper wick. The psychology here is fascinating. As soon as the period opened, sellers forcefully tried to push the prices down, but they just hit a brick wall. Buyers violently rejected those lower prices and pushed everything back up past the open. It's a huge reversal signal. If you're trading this, your rule is to enter a buy order just above the high of the pin bar. You put your safety net, your stop loss, below the bottom of the pin bar, and you target the next market resistance level. Okay, now let's flip that entirely upside down, the bearish pin bar. Here we've got a small red body with a massive upper wick. Buyers tried to surge upward, but sellers aggressively smashed the price back down, establishing clear dominance. So if you want to enter a sell position here, you trigger it below the low of this candle, and you place your strict risk boundary, your stop loss, right above the very top of that upper wick. Now, our third basic pattern is kind of unique. It's called the doji. Notice how it has nearly equal wicks on the top and bottom, and a tiny, almost invisible body right in the middle. This is the ultimate tug-of-war tie between buyers and sellers. They fought up, they fought down, and they ended up exactly where they started. Now, the doji itself doesn't actually pick a direction, but it signals a major pause in market momentum. And historically, a quiet pause like this usually precedes a wild, explosive breakout in one direction or the other. Alright, let's level up section 3. Intermediate patterns. Since we've mastered single candles, let's see how this battle unfolds over two distinct time periods. Enter the bullish engulfing bar. Look at how the big green candle completely engulfs, literally swallows up the entire previous red candle. The story here is intense. Sellers were totally in control during the red candle, but the second the next period opened, buyers violently overwhelmed them. They pushed the price down, scooped up the liquidity, and then surged way past the previous highs. To trade it, you buy at the break of the green high and tuck your protective stop loss safely below the new low. On the flip side, we have the bearish engulfing bar. It's the exact same psychological flip, just completely in reverse. A big red candle totally swallows the previous green candle. Buyers were steadily pushing up, right? But suddenly immense selling pressure steps in, steals control, and crushes the price down past the previous opening. If you're looking to sell here, you trigger it right below the red low and set your protective stop-loss boundary firmly above the new high. Getting to the really fun stuff now. Section 4. Advanced Patterns. Meet the Morning Star pattern. This is a brilliant three-part story arc that indicates a bullish reversal. Step 1. A strong red candle shows sellers are in total control. Step 2. A small doji or pin bar pops up, so the downward momentum pauses and we have a tie. Step 3. A massive green candle breaks out, closing well above the doji. Buyers have definitively won the tug-of-war. To capture this, enter a buy order above the high of the green candle, and make absolutely sure your stop loss is tucked safely under the lowest point of the doji. And naturally, the mirror image of that is the evening star. Step 1. A big green candle shows confident buyers. Step 2. A small doji appears. Buyers suddenly lose steam, and the tug-of-war pauses. Step 3. Bam! A massive red candle crushes the price to the downside, closing way below previous levels. Sellers have taken over the whole shebang. Here, you'd initiate a sell order below the red low, place your stop loss securely above the doji, and target previous market lows to take your profit. Bringing it all together in Section 5, Stop Loss and Take Profit Rules. So the crucial point here is that recognizing these 7 patterns is absolutely useless without strict risk management. Candlesticks aren't magic, folks. You need market context. Let's walk through it simply. Step 1. Only act when you spot these patterns at key market zones, like known support, resistance, or trend lines. Step 2. Logically enter at the break of the candle to confirm the momentum is actually real. Step 3. Set your stop loss safely behind the pattern, above the high for a sell, or below the low for a buy. And Step 4. Set your take profit at the next logical high or low zone. This turns a pretty visual pattern into a calculated, systematic, and safe process. And this brilliantly illustrates our whole journey today. Here's a comforting, structured wrap-up matrix of all 7 patterns, from the single candle, pin bars and doji, up to the 2 candle engulfing bars, all the way to the 3 candle morning and evening stars. Whether it's 1, 2, or 3 candles, the underlying meaning is exactly the same. They are showing us precisely when momentum is shifting from buyers to sellers, or sellers to buyers. It really goes to show how simple and elegant this chart language is once you just break it down. Well, we've done it. We have successfully decoded the language, we've mapped out the foundational battle formations, and we've established strict risk management rules to protect your capital. Next time you open a chart, you're not going to see a random mess of bars. You are going to see the psychology of the market unfolding right in front of you. Which leaves me with one final question to challenge you with. Open up your charts right now. Which side of the tug-of-war is winning today?